Sensitivity analysis in capital budgeting. My name is Kim, and today I'll walk you through how we can use this powerful tool to evaluate risk when making long-term financial decisions. I'll explain the purpose of financial management, the steps to conducting a sensitivity analysis, and how both internal and external factors come into play when assessing risk in capital budgeting. By the end of this session, you'll understand how to integrate both quantitative and qualitative data to make better investment decisions. Let's start with the fundamentals. The main goal of financial management is to maximize shareholder value by making sound financial decisions. It's about ensuring that a company's resources are used efficiently to achieve profitability and sustainability. Some of the core functions include capital budgeting, which involves evaluating potential investment projects to determine if they're worth pursuing. Capital structure decisions, where we determine the best mix of debt and equity. Working capital management, which ensures a company can meet its short-term obligations. And finally, risk management, which brings us to our main focus: understanding how to assess and manage uncertainty in investment projects. Sensitivity analysis is a technique used to predict the outcome of a decision given a certain range of variables. In capital budgeting, it helps us test how sensitive a project's success is to changes in key inputs like costs, sales volume, or discount rates. This analysis is important because it gives us a better understanding of which variables are most critical to the success of a project. For example, if a small change in sales volume dramatically lowers our net present value, we know that's a variable we must manage closely. This tool allows us to evaluate what-if scenarios and build more resilient financial plans. Now, let's break down the steps. First, we identify key variables that significantly affect project outcomes, like unit sales, operating costs, or the cost of capital. Next, we determine the base case scenario, which is our best estimate of these variables. Then we adjust one variable at a time, either increasing or decreasing it by a percentage, and observe the impact on financial indicators like NPV or IRR. By changing one variable at a time, we isolate its effect on the project's outcome. Finally, we summarize the results in tables or visual aids like tornado diagrams to clearly see which variables have the greatest influence. This method gives decision-makers a clearer picture of risk exposure. While numbers are essential, we also need to consider qualitative factors, those non-quantifiable elements that impact a project's risk. These include market conditions. Are we entering a competitive space or a growing market? Regulatory environment. Are there potential legal changes that could affect operations? Technology trends. Could advancements make our project obsolete? Management experience. Do we have the leadership to manage challenges? And customer behavior. Are there shifts in demand or preferences? These factors may not show up in a spreadsheet, but they heavily influence the success of a project. Including them in the analysis ensures we're not overlooking important risks. We can categorize risk assessment tools into internal and external methods. Internal methods include sensitivity analysis, which we've covered; scenario analysis, where we evaluate best case, worst case, and most likely outcomes; simulation models like Monte Carlo, which provide a range of potential outcomes based on probability. External methods involve looking at the market and the environment; industry trends, which can show where things are headed; economic indicators like inflation or interest rates; benchmarking, where we compare our project to others in similar industries. Together, these methods help us build a well-rounded view of the risks involved in a project. Once we identify and understand risks, how do we use that information to make smarter decisions? Here are a few strategies. We can adjust the discount rate by adding a risk premium, especially for high-risk projects. Use risk-adjusted hurdle rates to set a higher bar for riskier investments. Diversify the investment portfolio to spread out the risk. Consider real options analysis, which gives us flexibility in decision-making, like the ability to delay or expand a project. And most importantly, update your assumptions as new data comes in. Risk is not static. By integrating both quantitative and qualitative analysis, we make decisions that are more informed and better aligned with our financial goals. Here are the sources I used for today's presentation. These include corporate finance textbooks and a reliable online source. I encourage you to explore these further if you're interested in learning more about capital budgeting and risk assessment tools. Thank you for your attention today. I hope this session has given you a clear understanding of how sensitivity analysis plays a critical role in capital budgeting decisions.